Yeah, pretty good. Not too bad.
Sunny day in Melbourne.
Sunny day in Melbourne. We're very grateful to have the sun. Yeah. Apparently the ABS was just saying that there's been a massive migration of people in Queensland migrating south for the sun.
To Melbourne.
Yeah.
But no, I mean, that's pretty harsh to say at the moment, yeah.
Yeah, it is. But we do send our love and prayers up to everyone in southeast Queensland because it has been downgraded, I believe, to a Category 1 cyclone at the time of recording. So hopefully everyone up there is safe and sound. We were on a team call this morning with Gemma. Shout out to Gemma Mitchell. And she was saying people are just going to the beach and walking their dogs and
surfing a massive swell.
Yeah. Other than Dan Murphy's being closed, she's like, it's pretty much business as usual. So I hope that it isn't as bad as we suspect based on what we're reading in the media, and I hope everyone's safe and well.
I did hear that there was something like 40,000 homes without power in the Gold Coast at the moment. Anyway.
Yeah, well, yeah. That may be the reason my brother's not getting back to me, because he is he's just inland from the Gold Coast, and maybe that's why, but maybe not.
Maybe that's why. 3 weeks ago.
Yeah. No, he I'm sure he's got reception, but he's thoughts and prayers to everyone up north right now. But we are here talking questions, and we're filming live today. We are recording. Drew is at home, and regrettably, for anyone that is listening on Saturday morning, we're recording this live, and we've both been booted out of where we would normally record a remote discussion. So we're trying to make do with what we've got here in front of us. We've just sourced together some sound dampening, so hopefully the editors don't get too
apologies to our editor. Yes, to Monique.
Yes. I think we'll dodge a bullet with this one. I think Adrian will help us out. But today we're going to be talking about ETFs. We're going to be talking about some companies. We've got some questions sent through on Computershare, which is a company we almost never talk about here on the show, despite being a really interesting business. We've got RPMGlobal, which is a business that is included in my portfolio for our fake portfolio challenge.
We're doing an update on those too. Let's not do that today.
No, let's have a look. Let's just jump straight into that.
Some good news this week. Tesla and Nvidia both dropped more than 5% overnight. So,
oh, great. Well, if you are keeping up with the Australian Investors Podcast, every Saturday morning we air the show on Apple or Spotify or YouTube, wherever you get your podcasts. But on the very first day of this year, Drew set out a $10,000 portfolio. I set out a $10,000 portfolio. And the community voted and set out a $10,000 portfolio. And the results are in. According to the Navexa scorecard, you can use Navexa to track your portfolio. You can just plug it into your brokerage account, and it does your tax reporting for you. It is pretty awesome. So shout out to the Navexa team. So the Dizzy Rascals portfolio, which is the community portfolio, is currently plumbing at around about negative 5.4% as a total return.
What's the biggest drag?
At the moment, it is Vulcan. And KKR, which is regrettably had a big reversal. Let's say that, Drew.
Wasn't it up 30%?
It went from the number one performer across all three portfolios to the second worst or third worst. So, bit of a reversal, bit of a momentum. It's early days. It could still come good by the end of the year. So there's that. If we shift now to, this is the best one. That's the portfolio. My portfolio that was voted, was named by our producer Monique, and it has been a shocking week for the old. This is the best one. It has been a hard week. A week ago, it was the only portfolio in positive territory. We're going to be talking about RPMGlobal, which is down around about 13% at the time of recording. That is the worst performer for this one.
Of an earnings result.
Keep in mind that I do have leveraged ETFs inside this fake portfolio.
That was bold, very bold call.
So GGUS, which is the BetaShares S&P 500 leveraged ETF, I thought, well, if you're going to swing for the fences, swing twice. And it is stage of dramatic reversal. So it is currently down 7%.
What's the S&P's down? 4% for the year. So you can see you get double negative of what the market's done.
Double negative, but double positive.
Double positive as well.
Yes. So
we can skip behind this week. We don't need to talk about the everything.
And finally, for the everything eggs portfolio by Drew Meredith, we're looking. Oh, actually, it's not that bad, right? Like the community portfolio is down 5.4%. The everything portfolio is only down 6.4%. Now that's probably reassuring because Tesla, I think it all comes down to position sizing here, Drew. Tesla down negative 36%, Nvidia down 19%. What's your commentary?
But the purpose of this portfolio is to teach people an important lesson around position sizing. And when this is clearly not a core portfolio, and also patience and long-term investing. If I had the opportunity to be topping up, I would.
Oh, okay. So you'd be topping up on Tesla and Nvidia?
I mean, this is a perfect opportunity where if your holding goes below, usually if it's half the size, we'd look to top it up back to the original value. But when things fall something like 30%, they become underweight within your portfolio, and it could be an opportunity to top up.
Actually, this is a really good educational lesson for people. So you're saying, so this is just obviously not a real portfolio, like we're just having a bit of fun here, and everyone knows that. But so like you can go to our website, you can go to the Wattle Partners website, or you can go to the Rask Invest website, and you can see what our actual, like what we actually do for a living.
Not this.
Not this, but so you're saying like if Tesla is down 36%, but say, I don't know, Paramedicus is up 5%, right?
You're trying to find the one that's gone up, yeah.
Yeah. But so you're saying if the position size that you originally set out for Tesla is less than half, you would seek to rebalance into that. Is that correct?
Yeah. At that point, you either, and we look at it more from an asset allocation level when we're talking to clients, have our global equities fallen significantly enough that we need to top them up? Okay. But position sizing, if there's a holding within your portfolio that is less than half the size of everything else, well, one, you need to review the thesis, and if you're still comfortable and it's 30% cheaper, well, it's potentially a time to be buying more of it. And two is the question around, do you even continue to hold it?
Yeah, that makes sense.
I don't have the second choice in this example.
Yeah, so the rules of the game, everyone, was that we got 10,000 fake Navexa dollars, and you had to hold the investment until the end of the year. There's no buying or selling throughout the year. It is literally just buyer beware. And that's the rest is history, as they say. So in other news this week, Drew, we've got some big news. I'll just stop sharing my screen really quickly here for people that are watching. But in other news, ETFs to hit $300 billion.
I saw this come out. And we've talked about it, I think, in the US, and the trillions of dollars it's going from either mutual funds, so like managed funds, both active and passive mutual funds. Let's clear it's not just active mutual funds, into ETFs. So the listed product. And essentially, yes, there's a brokerage cost, so you don't avoid the buy-sell spread that you have on a fund. But I think you could suggest there's probably more transparency in ETFs and easier execution, which is making them more and more popular. I think State Street said they hit 200 billion in 2024.
Yep.
And State Street's one of the top 3-4 biggest providers in the world, and they're expecting it to be 300 billion this year. And I know you've met with the likes of PIMCO and some other groups recently, and active ETFs. It seems like there's a new active ETF launching every other week or every other day.
Yeah, so we did an episode with PIMCO last week, then a new advertising supporter of ours on our Australian Retirement podcast, just for folks that are familiar. And so is BetaShares, who I mentioned earlier on as the GGUS. But there was actually another thing that came to my inbox. As you would know, Drew, you said off air, if someone's calling you and you don't know the number, it's probably someone from finance trying to sell you something. But that's if you're a financial advisor. But there was a longtime sponsor of the show, GlobalX, actually sent out a media release not too long ago. And what they say, global equity exchange-traded funds were the star performers in 2024, drawing over $16 billion in net flows, up 23%. So that's according to the latest ETF landscape report from GlobalX. So $5 billion was added to US equities, doubling the previous high in 2021. And they suspect it could continue this year. So there is a serious amount of momentum now, money just pouring into ETFs. And we should be really clear about what we mean when we talk about money inside ETFs. We're not saying like this is like new money going in. It's the amount of money already in there. And that could be from contributions, as Drew was alluding to, or it could be from the value of the investments going up, which we hope they do over time. Jason Beck on YouTube did come through with a quick comment here. Just snuck one in. Thank you, Jason. Says, do you think the Dow will fall below 15,000 points during this year? Geez, okay. Let's just have a
42,000, isn't it?
Jason, you're saying 15,000. We're at 42,000. That's a long way to go. I hope not. Imagine if it is.
I mean, what you could be saying is like a 30% drop from 45,000 points. And 30% drop, I mean, we call it 10% drop a correction. I was just doing some research on that. And basically, you should expect a 10% drop at least once a year, maybe just over once a year. Now, these days, we see a 10% drop and it recovers pretty quickly, at least for the last 3 years, where it's been probably one of the best environments to invest in my generation, probably multiple generations, if I'm completely honest. But a 30% drop, I have to check the data. It's more like every 6 to 7 years that you have a 30% drop on average. But that doesn't mean you can't have two in a row. Oh, the NASDAQ. Whew.
Oh, sorry, NASDAQ. Oh, phew. Jason, thank you. Almost gave us a heart attack. He knew something we don't know. But
my answer was probably where I was going, which was very similar, which is, basically toss a coin. Being able to predict what the NASDAQ, the S&P, the Dow Jones are going to do this year is near on impossible.
So the NASDAQ to get to 15,000 would only be a 25% fall from here. 20% fall from 20% fall from
We're already off a bit too, though, aren't we?
Yeah. So we're already down from 20,000 to 18,000. So I mean, so there's a really good website for everyone that's listening or watching. It's called curve.eu. And what it actually shows you, Jason, or for anyone that's listening, if you go to curvo.eu, it shows you all of the analytical data on drawdowns, market corrections, crashes. Totally free, by the way. So you can just go and check this out. Over the last 10 years, the S&P 500 has annualized at 10.6%. But you can see serious drawdown years. You can see the GFC was at 37%. It's the worst. I think it's one of the worst years ever, if I'm not mistaken. There have been worse periods. Yeah, there have been worse periods, like in the Great Depression in the 1970s. There were multiple years where the market went backwards double digits. But in an individual calendar year, I believe that's the worst on record. I could stand to be corrected on that. And the really interesting, the really fascinating insight is up here, Drew. You can see it on the screen, which is the S&P 500 index has had a positive return during 26 of the past 32 years, which is 81%. Now, I'm not one to stare into crystal balls, but I do stare into the sky every now and again. Since the year 1900, the Australian share market has also shown that exact number. So 81% of years are positive.
So every year there's more potential than not that it's going to be positive. I mean, calendar years are obviously very weird periods to actually measure over because the market doesn't care about calendar years or financial years and I think it kind of reiterates the role of global shares, global equities, that they're constantly evolving, and that's the S&P 500, where 30 years ago, it was all 5 out of the top 10 companies were Japanese. 20 years ago, 5 out of the top 10 companies were oil companies, and now most of them are technology companies. So that's with an S&P 500 that constantly evolves.
So here you go. We've got from market, courtesy of Market Index, we've got 125 years of data. 81% of years are positive over the last 125, but the 2008 calendar year is substantially left of tail. It is like the only one that falls into the minus 40% bracket. So
that's one of the most difficult things I've seen in my career. I mean, it has to be because look at it. I mean, but understanding that when you're, I think I came out of uni 3 years before that. Or 4 years before that. So trying to understand what was actually happening was incredibly challenging. All the movies that came out since obviously helped explain it in a bit more detail, but being there firsthand and watching that happen and watching the values and then watching what happens when it turns, I think is probably more insightful.
Yeah. Well, the thing is,
the way down.
We talk about this a lot and on the show, but a lot of people do tend to kind of miss this point that oftentimes the worst year is next to the best year. So a lot of people try and preempt a market crash, and that's why Peter Lynch famously said, more money has been lost waiting for a market crash than in one. And I kind of believe that because the year before the market crashes is often quite a very good year for returns. And then the year after the market crash is often quite a good year. And so, for example, we can see in this data here for the Australian market, 2008 was the worst year.
Yeah.
But 2009,
the market bottomed in 2009. It actually kept falling until March in 2009, but still had the best year.
Yeah, but still returned 30 to 40%. And so 2006, 2005, also some of the best years. So it's rare that you don't get really good years that follow really bad years. And so that's why a lot of people just tend to ride out the bumps. Another good question sent through live. And before we get into more questions, I should say that anything that we do say on the show is strictly general in nature. So we don't know anyone's needs, goals, or objectives. So if you do send in a question, either in advance or live on the shows, any of the Rask podcasts, we don't know what your objectives are. So be sure to speak to a financial planner. If you don't have a financial planner or you want to find one, you can follow the link in your podcast player and YouTube description there. And it has some education around how to find a financial planner, but also the financial planners that we work with, like say Drew here. The finance guru on YouTube says, I'm in my 20s, so we'll kind of disregard that for the purposes of this question. Sorry, finance guru. And I've allocated 70% to international shares and 30% to Aussie shares. So it's a 70% international, 30% Aussie. Typically speaking, how much of the international shares is currency hedged? So we won't say this specifically to you, but we'll just talk about just generally currency hedging. And I'll go first. Is that a lot of people do just cut it straight down the middle. And they just go straight down the middle. Half is currency hedged, half is not. This is a really common strategy. It's a really simple one. Is it the most effective? Maybe not. But a lot of the literature points to like results and findings from the perspective of pension funds and big institutional investors. And most people are not super funds, like they're not Australian super. So you don't have the same obligations to yourself like they would to 2 million super members. So it's kind of hard to get a good answer on this, Drew. I'm curious to know what you would think.
I think, you have to have a starting point and try and have a policy. And this is what, I guess that's what you're trying to build. I'm wary of giving you a recommendation. Obviously, it's personal. Our starting point generally is to be completely unhedged, or when we run both a completely passive portfolio and a core satellite portfolio. So the general position would be to start being completely unhedged and then make a decision as the currency moves. And then for the complexity, which I'm sure you'll be referring to, is the old standard deviation rule. So like everything, markets generally work with mean reversion, which means things tend to eventually go back to their long-term average. The long-term average of and this is where this comes into your currency discussion. If the long-term average of the Australian dollar is probably 72 cents at the moment, when the actual dollar falls is 2 standard deviations outside of that, which I'd suggest is probably around its current level, that's a time when you need to be reviewing and reconsidering your decision. So if the average is 72 and it's now 62, this is, at our investment committees at the moment, hedging currency is incredibly topical. And each decision, particularly the incremental dollar that's going in, obviously it's hard to sell things with profits and realize capital gains. And then in the core, that's in the core portfolio. In the core satellite, you generally have actively managed currency within the active fund manager, usually managing currency because it's across multiple jurisdictions. So you're worried less about currency hedging, but understanding how much is hedged.
I put myself on mute there for a second, accidentally. So yes, I can bring up that chart for anyone that's watching or watches back on YouTube. I'll walk you through it if you're listening. But typically, it depends on over what period you measure like the currency as to what average you'll get, obviously. But typically, we say it's like high 60s, low 70s. And if we were to zoom right in to like what's the standard deviation, what's the range that Drew's referring to, and we recently hit that in October last year, and we're very near to the bottom end of the range, so to speak. So if you apply a formula like this, you can just Google Rask currency hedging, and our page will come up and it will show you the long-term bands of which the currency moves in. And this gets quite technical, as you can see, and it kind of, in my mind, it's kind of getting into the realms of technical, like a charting. And the reason that we don't know the answer is because it is very difficult to predict for different portfolios. Currency is notoriously difficult to predict.
And turns quickly.
As much as people try and trade currencies, it's just fraught with risk and error. And probably the biggest one is interest rate parity, which is this idea that effectively money around the world flows to the markets with the higher interest rates. And so where big investors can get a better yield on their bonds or their whatever, they typically invest there. So that typically puts pressure on the currency, and you tend to have like a normalization. Obviously, the US market's the most dominant from a financial markets perspective. So it's basically everything is referred to against the US dollar basket. I don't want to bore too many people, but or get too far in the weeds, but there was a really good post recently from BetaShares actually, which showed that through some modeling that if you have your core portfolio, there's an argument to be had that I think I'm going to butcher it, so apologies to BetaShares off the top of my head. It was either 20 or 30%, so up to say 1/3 of a core portfolio, like its allocation could be currency hedged. And if you look at our portfolios at Rask, we have currency hedging. The more exposure we have to international markets, the more currency hedging we typically apply. But even still, at the moment, it's 25%. So if that's like a useful yardstick for people, we've gone 25%. It's not all or nothing, is probably what I'm going to say.
And for those listening for the first time, increasing Australian dollar equals bad. For people, Australians investing overseas, falling Australian dollar equals good, like for the most simple.
Yes. And you can just go 50-50, which is why we kind of started with that. So if you're confused, 50-50 is fine. So there was a question sent in from Sassy's shareholder in advance, Drew. Hi, guys. Love the show. I'd also love to get your thoughts on RPMGlobal's recent results and the decision to divest its advisory business. It seems like a good move to focus on their SaaS business, however, may have overshadowed its weak-ish results. Do you think it was a subscription slip-up, or it positions themselves as the future platform powerhouse, or even a takeover target? Cheers. So, Sashi's shareholder, you will know that RPMGlobal is in my model portfolio. It's also a company that I've held many times over the years and have recommended to our members. So I'm just going to bring up RPMGlobal's recent results on the screen, and I'll walk anyone through it that's listening. We can see it here. So RPMGlobal, just as a bit of a backstory, it creates software for the mining services and mining industry. So effectively, if you go to a mine site, you might have software that helps the mine engineers predict where to drill, or the most optimal way to have the trucks route through that mine site and to be more effective, and for the team that oversees the entire mine site to get good data and information. It also has a lot of software around things like maintenance schedules and project schedules. So things like if you've got one of those big trucks that looks like a Tonka truck, those things, like they wear over time, right? So you're trying to get a better handle on how do we optimize that truck's usage through time. How do we know when it's going to need maintenance, and how can we plan the mine site for that? So all those types of things. And so we can see for the first half of the year, revenue was up 10%, but profit for the period was down 30%. But if we drop further down, whenever I see something like that, I always drop further down to actually see what's happening, because that seems like an odd thing that revenue would be going up so fast, but profit going down. And what we can see is modest growth from the software business. So they break it out as software or advisory. In the 1970s, I think it was off the top of my head, RPMGlobal, which the actual RPM, what it stands for is Runge Pinnock Minako. And it was started by Mr. Runge. I can't remember his first name. But the business started in advisory. So you would go to them and they'd be experts in telling you where to mine, what to mine, and how to do it. And over time, Richard Matthews, who's the current CEO, came in 2012, 2013, and subsequently bought a lot of shares in the company. He had so much conviction in it. And his background was technology. And he could see that RPMGlobal was effectively in a position where it was giving so much expertise and intellectual property from its advisory team into the miners.
Yeah.
And they said, why don't we just use some technology to try and underpin this and continue to grow the technology suite? And they've since done that, and their software business has been growing massively. And you can see here that they've actually provided, even though software revenue only went up 2.4%, you can actually see that over a longer period, it's actually growing up. It's gone up considerably. So there's a 6.8% in the prior corresponding period. Advisory division was growing. If you ask me, though, to be honest, it was probably just a matter of time before they started to sell they thought about selling the advisory business. They recently sold their geogas business. And I think it's a good move, because if it emerges as a software business, a pure play software business, I think it's going to get a higher profit multiple. I think maybe it becomes a better, more saleable business. There's been some sales in the mining software industry over the past 2 years, some big ones as well. So maybe it's positioning for an exit. But broadly, as long as it can continue momentum, it should be able to keep more of that income dropping to the bottom line as a software business. So broadly, I think it's a good business, which is why we included it in the portfolio, which is I think my portfolio was equal weight, Drew, so it had $1,000 in there. Where is it? RPMGlobal down 12%. I don't know if RPMGlobal will end the year up, but what I do know is that over the long term, it's a really good business and it's got really good management. It's a little bit expensive, but it does everything that I would expect it to do. Transitioning away from an advisory business will take the revenue down, but maybe over the next few years, the profit goes higher because of that.
The software is still underpinning it all. And
Yeah.
you'd probably build more clients for your software business by doing the advising and consulting business. But I don't know a lot about this company either.
Yeah, so this business, in the early days, if you've got software and you just come out with great software, I'm just showing WiseTech Global on the screen now, which has also been hit recently. If you think about software for the mining industry, software for the mining industry is quite similar to software for the healthcare industry, in that if you're the biggest mine in the world, you're not just going to use some new software that's come out from some little software company, because it's too risky. You might blow up the whole mine by just using some crappy software. So what they tend to be is what we call fast followers. So if they see someone else do it, then they'll do it. And we see that momentum building with RPMGlobal, similar to the first instances of what we saw with Pro Medicus in 2014, 2015, I think it was, where they won the Mayo Clinic, which is like the world's most prestigious hospital, so to speak. So once the Mayo Clinic signed up to Pro Medicus software, which is healthcare software, you saw every other big US hospital want that software. So the advisory business was needed in the early days to try and plant the seed and to get people using the analytics and the data. But maybe now it's not so much. So that's a really interesting one. So so Dolly's actually followed up with a really good point on YouTube to the Finance Guru about the currency hedging before. There's a lot of commentary about 50% hedged. And Dolly follows up and says, if you look at the holdings of diversified ETFs like DHHF, I think it is 50% hedged. I have to double check. But yeah, it typically is what kind of the rule of thumb for people is. Yeah. Drew, what else is making news this week?
We had APRA come out overnight, which I thought was quite interesting. It's talking about like the legislative side, suggesting that insurance companies, banks, and super funds directors should only have a tenure of 10 years. Naturally hit with headlines and derision and lots of concern. But I thought, that's super interesting, because you have this almost group of directors that kind of swap from BHP to Woolworths to hold multiple positions at the same time. So I always think, and you probably agree, from governance terms, refreshing and changing is great, but like everything, I wrote an article this week on a similar track, is that there has to be some level of autonomy around it. It's personal choice, it's shareholder choice, it's company choice. Coming over the top and then determining those things, they always lead to some sort of inefficiencies, in my view. But that's more of don't want to get philosophical, but I think that's where it sits with me.
But do you know why APRA wants that to happen?
I think there's a concern that, and this is a concern across every business, I'd suggest, that if people are in the same position, at a board position, so essentially the board represents the shareholders to the company, and they're supposed to keep management to account. So the CEO reports to the board. The board is there to not just, they're worried about them just ticking the boxes in terms of governance, in terms of strategy, in terms of how the business is running. So if you've got fresh people that, consider it from a different angle or don't have relationships with the executive team, they're hoping to refresh and create more, I guess, a higher level of governance within businesses as well. Which I think everyone would be happy with that. I think it's always questionable when you go, that's the old slippery slope argument, where you change something like this, like the retirement income discussion we had. And then overnight, what else are they going to, what else can they tell us to do? Does that mean CEOs only get 10 years? Does that mean politicians now get 10 instead of 4? But not that APRA can rule on that, but that's
Imagine if they did. But if you look at, say, like in the United States, and you look at like Berkshire Hathaway, which owns Geico, which is one of the biggest general insurers. Imagine if they were like, Mr. Buffett, you've been good, time to get out.
It's been more than 10 years. That's exactly right. So it's maybe you should. Who knows?
Yeah, but it's hard when he's the world's best, investor to say, listen, the rule says this, so you're out. Get lost.
And there'll be exemptions, and then there'll be lobbying, and then there'll be But I thought that was super interesting.
Yeah, it's quite interesting because the reason for people that are listening and don't understand the context of this, what it basically means is APRA regulates the businesses in our society that have the most, systemically, like they're the most important to our society. So things like life insurance companies or insurance companies that are insuring against floods in Queensland right now, like who's stopping them from doing the wrong thing? Or like a bank, like what's stopping Commonwealth Bank from just defrauding people? Well, that's probably a bit extreme, but like not having risk, an understanding of their risk in place. Like if that was to go down, the whole country goes down. So APRA steps in and oversees these organizations, and that's what effectively they're there to do. And so it makes a lot of sense that they would have a higher level of regulation, but imagine if they tried to do that to a smaller company. There was a question here. I don't know how much you know about this business, which is Computershare, for folks that are interested in Computershare. Given how popular Computershare, ASX CPU is the ticker symbol, is as a registrar for stocks and ETFs, is it a good hedge for long-term growth? So I'll bring up the share price of Computershare here now. So we've got this here.
Had a nice pop.
Did it really?
So Computershare, I think it was on your on the Rask community site today. I got an alert about someone complaining about the registries and how poor they were. So Computershare, I think, being two of the biggest registries.
Yeah, it would. Oh, they definitely are. They're horrible.
They still feel like, but part of that's due to the chess system as well. So to be involved on the chess system to get the benefit of that, you basically have to use a share registry. Which is not, it's probably a duopoly, maybe an oligopoly, if we can talk about that, which is that there's Link, there's Computershare, there's Boardroom, there's a few others, but ultimately they're pretty well controlled. And I think what is often talked about is Computershare's inflation hedge or interest rate hedge, in the fact that they actually hold, in my understanding, they hold on to the dividends before and distribute them on behalf of and takeovers and all the kind of major transactions on behalf of the companies and help administer those. Yeah. And anyone that I can just to misery loves company. Yeah, it's horrible in terms of the experience of logging into a share registry. It just needs to get way better. But yeah, so let's just have a look at the recent results for the 31st of December, 2024. Revenue was down 6.7%, but profit, so again, we would have to dive deeper into the results, was up 173%. The dividend, 42 cents. Versus Suggest there was a write-off last year, and it went up based on the write-off of last year of some part of their business. But then there you go, sales revenue, interest received. Yeah, so sales revenue, like actual sales revenue was up. Interest received was pretty steady year over year. If we drop down, where are the costs coming out? So we've got costs out of technology. We've got no other real costs. Income, expense, tax expense. There's really nothing to explain. It's just a bunch of little bits moving all in favor. There's a bit of other income, but nothing major that jumps out to me. But one of the things that people talk about, and maybe this is where the hedge comment comes from, Drew, which you were alluding to, which is that
because Computershare holds on to people's cash, it has this kind of interest income reserve where it can make money from other people's money. It's kind of like how the big platforms and banks do it, right? Yeah, and so
they're operating a bank account.
Yeah, exactly. So if you get dividends and they hold on to your dividends for 10 days or whatever the case may be, but we did see it like a pretty material pop in sales, while the actual expenses from the business did not increase anywhere near as materially. So that's what led to the pop in share price, most likely. Do I see it as a really interesting business? I think it's a really stable, solid business, kind of like many of like the ASX, you could say, is it's like a toll road on investing. But I've always looked at Computershare, and the only time that people really talk about it is when is after it's had a pop, and then I've often found that that's not always the best time to start looking at it. Yeah. So it's a pretty steady business. It's pretty easy to model. At the end of the day, what good investing is, in my mind, over the long term, is just finding companies that can consistently compound. So not just 1 year or not just 2 years, but 5 to 10 years. I think when I was speaking to Matt Joss, who runs Maven Funds many years ago, he taught me something which was quite interesting. He's like, when you look at companies that can compound, the most important period of compounding is not 1 to 5 years, it's 5 to 10 years, because that's the period when people have the least confidence and the ability to forecast effectively. But if you look at companies, and we see this all the time, I've spoken about this many times, over time, what is the best determinant of a company's long-term success is its growth after 5 years. Yeah. So like if you are a true investor in individual companies, you've got to find companies that can grow revenue and profit beyond the 5-year period, not 1 to 5 years, but beyond 5 years. And the reason that is important is because statistically, in years 1 to 5, what's more likely to explain your return is actually just the change in valuation. Like, will people pay you more for Computershare in 2 years than they do today? That's more likely to be the determinant of your return. Versus over 5 years, what is more likely to be the determinant of your return is, has the company consistently grown its profit? And so if you think about that, the longer you look out into the future, the more you need to focus on competitive advantage and industry dynamics. Can it grow faster than industry? So, Drew.
And this one, I mean, Computershare is a perfect example, because you could just sit there and rest on your laurels and accept the business that you have, that it's going to keep compounding at a reasonable rate. But that often leads to failure. And like the first 5-10 years, you can do that probably when you've got a duopoly. But competition comes in. What happens when chess changes? If it does,
ever, yeah.
Another question. But you can't rely on that. It's about these companies, and that's what you're talking about: evolving, finding, like you talk about going from advisory for RPM. Out of advisory back to advisory. It's about constantly evolving. And I mean, that explains why 80% of years the share market goes higher, because every company is doing something different every year, or most of them. And if they're not, they disappear and get overtaken by someone else that is.
Absolutely. So the way you can join together all of those things that we just said, if you're watching, I'll show you on the screen, but if you're listening, I hope this makes sense. The way you join the long-term growth of a business and its competitive advantage together is through a common metric that many of you will know, which is return on capital, return on invested capital. It doesn't really matter too much which one you use. You just don't want to probably use return on assets because it's a different calculation. But if you look at the long-term return on capital of a company, that's indicative of the ultimate return that you would get from owning that share if everything else was held equal.
Yeah.
The reason that the stock market works is because companies can earn higher returns on their money than an individual can. That's why they work, because an individual might be able to buy an index fund or go and buy a local cafe or something. But if you can create the next Combank, or you can create the next whatever, it's like infinite amount of scalability. So if we look at Computershare's return on capital, it's hovered recently around 19%, 18%, going backwards 14%. But there was a period before that where it was 6% and 9%. And so it's no real wonder over time that the profitability has gone up, because effectively what this metric captures is, are you earning more? Like, are you generating more sales and profit? And are you deploying less incremental capital? So are you putting more, like less money to work to get that higher return? So that's where you get this kind of idea of jaws and long-term returns.
And also, you want to look at the cost of that capital as well. So if your return on capital is less than your cost of capital and your cost of debt, well, what's the point?
Yeah, so if you've got to pay more in interest, then you
don't want to invest into a negatively gearing company. But if there's hope that the company's growing, that's where technology came into it a lot.
Yeah, well, let's look at the return on capital of Computershare, which is, say it's averaged around 11, 12% through time. Let's now compare that to, why don't we go household favorite Pro Medicus? Let's have a look what Pro Medicus has been up to since 2008. Waiting for it to load. Okay, so Pro Medicus's return on capital deviated from Computershare in 2014 when they were both around 10 or 11%. And since then, PME's gone from 30%, 35%, 37%, 46%, 44%, 46%, 55%, 56%, 57%, 58%. That is unbelievable returns on invested capital. And that has shown you that their industry is going. Remember I said the Mayo Clinic was somewhere, I think it was around 2014, 2015.
That's why the share price has gone crazy too.
That is why the share price, because every year, for every dollar of money inside of Pro Medicus, whether it's debt or whether it's cash in the bank or spending that they're making, the return on capital figure shows you how much of return they're getting from that money every year. Imagine going to the bank and saying, I'll have a 46% return this year, please. You wouldn't get it. That's why investing in the share market in great companies actually works, and keeping your money in shares over time does not. Now, here's a bit of final one on this, Drew. Will NVIDIA's return on capital be higher than Pro Medicus?
More recently, yes.
Okay, let's have a look. We'll wait for it to load here in ticker. Oh, yeah, you're right. It's got a 90% return on capital in the last couple of years, 60% before that, but it was plumbing below Pro Medicus until 2022.
That's when people hated it. But that's like, you got to invest a lot into your production and then see demand surge, and then you got a scalable business.
And that is why the share price has done this.
Just don't look at the most recent part. That's fine.
So since 2022, it's gone from $23 a share to $135 a share. And that's because the return on capital has been so good. And what people don't appreciate is you can't just go and find the company that has the high return on capital now.
Yeah, because it's expensive.
You've got to find the one that has the higher return on capital in the future.
Yeah.
In 3, 4, 5, 10 years from now. That's what
everyone hated. Everyone hated NVIDIA 4 years ago. Like, everyone thought it was a cyclical company. It was investing too much into its physical assets or in production capacity, and then bang.
What the fancy part of Collins Street tries to talk about is they try and talk about this idea called incremental return on capital. And basically the difference is how fast has the return on capital figure gone up in the last year based on the newer money that's left in the business. So for every extra dollar in the business, what's that dollar doing? And then that can kind of give them a hint of where the future returns on capital for the whole business are going. And so a really good example of this would be like RPMGlobal, which we spoke about today. It has the advisory business. If you looked at its incremental return on capital 10 years ago, it'd be pretty low. But you start to see it invest more and more and more into software. You would start to see, if you stripped out a few things, more incremental return on capital. So the extra dollar that they're investing in software has actually got a way better payback period than traditional advisory, until it gets to a point where, well, we no longer need the advisory business because we can just keep investing in software, for example. Yeah. There's a final question here, which is from Mr. Leftovers on YouTube. At work, lads, we'll watch the whole video later. This Arvo Friday night is sorted. Good luck to you, Mr. Leftovers. Have a bottle of Pinot or something. Maybe not a whole bottle. Thoughts on emerging market ETFs like NDIA or IIND, which are India ETFs. I think they're from BetaShares and Global X respectively, just off the top of my head. I believe Indian markets will bounce back. Ideal allocations for any such type of ETF. So just generally speaking, Drew, when you think about emerging markets, how do you think about positioning that with the team at Waddle and Atchison?
It wouldn't be an episode if we didn't say it depends. And this all depends on your objective. Like if your objective is to match the market, well, you just buy the broadest, biggest index funds, and you don't have a major exposure to these. If your objective is to find alpha, outperform, or to even more importantly, smooth your returns, then you start looking at the things like this, which fall into the satellite. So your core will be your MSCI, your S&P 500, and exchange and not exchange, but emerging markets fall into the satellite. So India, one of the biggest economies in the world, also one of the fastest growing. I know the market's off something like 16% since September. Actually had this on my list of topics today too. Always seen as quite attractive, but also in different ways to China, or also kind of very different capital markets. So as a base level, the way I look at my money is basically 50% is in the core and 50% is in the satellite. And that satellite is going to be split up between 5 and 10 of these type of opportunities. So I like Asia more broadly, as opposed to buying a broad emerging markets ETF, and Asia includes India, obviously. And then I like things like smaller companies, mid caps, and then value or quality. So I'm looking at like a portion of that half satellite that I've got in my global equity exposure.
We've had that's a really good answer. We've had some questions come through. We don't invest in Asia specifically at Rask Invest. We invest in a multi-factor fund from VanEck, EMKT. It's the ticker symbol. Not a recommendation, but it's a small allocation as part of our global equities allocation. Navar Trosselud from Navexa, who created the portfolio scoreboard. Navar from Navexa says, sorry I'm late, I just joined. No worries, Navar. I hope you're well, mate. So that's a great question for Mr. Leftovers. There are 2 extra comments here which I wanted to address, one from Jonty, one from Jason. Jason has a short story which fits into one YouTube comment, which I think is a hell of a short story for one basic sentence. I put 93% of my super, around 60K at the time, into physical gold ETFs. At the end of 2019, the balance now $165,000.
So now, my suggestion is always rebalance.
That's not a recommendation, but what we would say is, Jason, good on you, good on you, mate. But yes, good on you. Think about like the next 20 or 30 years, and as your balance gets bigger, does the traditional principles of portfolio allocation work? Like, it's for most Australians, it's really important to take risk early in your life because you have time to recover from it. But risk should always be calculated, like understanding that gold could have gone the other way. Obviously, Jason assessed that it went the other way in this instance, but having that underlying like framework, which Drew mentioned before, is really important. But as I find it, Drew, as people's balances get bigger, they become way less worried about the small things, or, how much am I paying in brokerage? Do I need this? Do I need that? And they just want someone to manage it, and they don't want someone to blow it up, basically. It's like natural that as you get bigger in your balance, you can become not always more conservative, but you do become more prudent, is probably what I would say, and more thoughtful about your asset allocation. So just something, Jason, as you, I'm not saying you haven't been investing a long time, but just something to consider anyway. Jonty, you say, hi, gents, very green to investing. Can you explain PE ratio to me? More importantly, how do I actually dissect it? Okay, so you've given us some tips.
Just ignore it.
Just ignore it. Let's explain it first. So the price earnings ratio, Jonty, just really quickly, is just it's got a P and an E, right? But so what we describe it as is price to earnings. So we say share price divided by the earnings. Why do they say earnings? Because that's the American way for saying profit. So if you were in Australia, you would say PP, price to profit. So if you took the share price and you divided by the profit per share, so $10 share price, and the profit per share was, or earnings per share was, say, $1, it would be 10 divided by 1 equals 10. But people overuse the PE ratio, Jonty, and it's a natural heuristic for new investors to understand something simple like that. As in many things in life, oftentimes the heuristics are the things that we remember when we learn something new. And I think that if that's where that's something you want to learn, we have a free course on that. And as you evolve it as an investor, you'll discover more and more tools and the benefits and the pros and cons. Like Peter Lynch took it one step further in his book, One Up on Wall Street. You can learn about it. He talks about the price earnings growth rate, or PEG, PEG, which some professional investors still use today, which is basically comparing the price earnings ratio to the growth rate to try and determine, well, some companies need a higher PE ratio because they're growing faster, like NVIDIA, which we talked about, Drew.
The idea is, how many years it takes you to get paid back, basically. So if you buy a company on a PE ratio of 10, the value you're paying it's going to take you 10 years of that company's current earnings to pay you back. Not dividends, but as in like the value of what you've bought. But you could look at something like NVIDIA, which traded on 100 times PE, and you'd expect you need 100 years to have that paid back. Well, paid you back in 3 months or 6 months. So your PE is just measured at a point in time and generally very historical looking. And that's why the PEG ratio comes in, because that's more forward looking.
Drew's got some messages. He needs to get to the hot tub time machine. But we'll get a dad joke for you now, please, queued up. If anyone asks a question today, whether live or on the show, please send us a message on the Rask websites, because you do get a free pass to the Value Investor Program. So that includes everyone that asked a question, Sassy Shareholder. Alex, you did ask the question about collecting gold coins. Maybe we can get to that next week. And the investor who asked about Computershare was Whittle Wattle Rascal, which is a good one. While you're getting that queued up for us, there was a quick question that come through from Derek D on YouTube. Any thoughts on the new Vanguard ETF? I think there's Vanguard ETFs, plural. And these are diversified ETFs. There is the All Growth ETF from Vanguard, which was a natural extension of what they were already doing. I haven't had a full review of it, but VDAL, as it's pronounced, as a ticker symbol, VDAL. When I heard about this, I was like, it just makes sense for a lot of people that they would have that as part of their core. I still prefer individual ETFs rather than diversified ETFs once someone's portfolio gets along, Drew, but just because it gives people more control. It's the diversified ETFs are absolutely wonderful for investors that don't really want to think too much about it and probably have smaller balances. But as you get on, maybe you want a little bit more control for things like tax, for things like automated rebalancing, which can be not always working in your favor. And so things like that. But I just think it's a good innovation, generally speaking, and there's more to come, not just from Vanguard, but just in the whole industry. So, Drew,
I just got a message about my haircut that's what the ding was, because for some reason on iMessage you can't hide alerts, but that's fine. But shout out to Michael who sent that question mark, and yes indeed. And I've got a dad joke for you too.
Go, give it to us.
I got an A on my origami assignment when I turned my paper into my teacher.
I don't get it.
The origami turned into...
I must admit, I'm not up with folding paper as much as I used to be, Drew.
I think it's my second origami joke in 2 years, so credit to me.
Credit to you indeed, good sir. You did actually tell us a dad joke yesterday that's going to appear on an upcoming episode of the Australian Investors Podcast, which is an absolute cracker. So, So Drew does his best work off air, but mate, that's been heaps of fun. I know it's a long weekend in Victoria, so I hope you enjoy the weekend if you manage to get down to the beach. But everyone, stay safe up there in Queensland. Our thoughts are with you guys. And if you're everywhere else, have a wonderful weekend. And we'll see you next Saturday morning on the Australian Investors Podcast. Don't forget to share it with a friend if it helps you. So, Drew, as always, thanks for joining me, mate.
Good to see you.